In this video, we'll learn how to trade on Binance futures. I'll show you exactly what crypto futures are, how to trade them, how to navigate this screen, and then how to think about the leverage that you can use when trading futures if you want to. So we'll get straight into an overview of this screen first. If you haven't got Binance yet, I'll leave a link to them below. You can get some bonuses there up to around $600. So check the link down below if it's available for you. Also, if you need a beginner's guide on how to get set up with an account and everything, I'll leave a beginner's tutorial for Binance down in the description as well. But when we come to Binance futures, you can come up to the top of your screen and there should be a futures tab here. So you can just click on futures and then you want to click on the trading screen. So USDT perpetual right here. If you click that, it'll take you through to this screen. So this screen is how we trade futures. And what exactly are futures? Well, they are a synthetic contract based on the price of another asset. So crypto futures on Bitcoin is a way that we can trade the price of Bitcoin without actually trading Bitcoin. So we just simply take positions on the price. We can take a position long, which means that we think the price is going to go up, but we can also take a position short, which means we actually think the price is going to go down. Now, we're not buying or selling any Bitcoin right here, so you can actually either go long or short just as you want to. So to sell or go short, you don't need any Bitcoin. To buy and go long, you don't need any Bitcoin. We're just taking positions on the price of Bitcoin. So an overview of the futures trading screen. If you trade spot already, it's very, very similar. There are a few differences. So we have the chart right here. I would be using TradingView here. This is great software and you're given it for free in Binance. So you can click TradingView and then we'll go through some of this later on. But up in the top left, we have the assets that we're trading right here and the price of them and some contract details, which we'll go over in a second as well. Then you have the order book right here, which is obviously the price of the futures contract based on what asset that you're trading. So, we're trading Bitcoin USDT right here. So this is basically the Bitcoin price or the Bitcoin futures price. You have all of the trades down here. And then at the bottom, we have some differences from the spot market, whereas we can see our margin ratio. This is if we're trading with leverage. Of course, trading with leverage means that we're putting an amount on the platform to fund our positions. We can trade with more money in the market than we actually have on the platform. We're funding those positions. And so you're given a ratio here about how much risk you're taking and how much the money you actually have is funding those positions. Obviously, if you're funding the positions with less, then that margin ratio is going to get very tight. If your positions are in a lot of profit, the margin ratio is going to be fine for you. And then we have the assets down here that we can get assets into our futures trading account. The first thing we can choose is what type of futures contract that we actually want to trade. So you may see futures right here and it says USDT perpetuals and coin perpetuals. And then you have the deliveries as well. What's the difference here? A perpetual contract is one that, of course, has no expiry date, therefore it's perpetual. This is what most people trade. It just simply lets you trade the price of, the assets that you want to trade. And there's no expiry that you're trading here. So you just open a position and that can be open for as long as you want it to, and then you close it whenever you want it to. Delivery futures have an expiry date, and so you are trading for that expiry date. So with delivery, you can say, by this date right here, which actually is 24, so that's the year, 03 is March, and then the day is 29. By this date, what do I expect the price to be? And, what price are they trading at now? Because if you think the price is going to be higher than the delivery date, then you can go long. If you think the price is going to be lower than what's currently trading at that delivery date, then you can go short. Most people in crypto will trade perpetuals. And so we're going to go through that in this video. The other thing to choose when trading futures is what kind of collateral that you want to use to fund all of your positions. Unlike the spot market, where we're simply using cash to buy things, and then if we own those things, we can sell them for cash. In crypto, like I said, all we're doing is taking positions on the price based on a contract through Binance. So if we're going long, someone else is going short, and we're taking that position against them, right? So how do we actually take those positions? Very simply, we can put an amount of money on Binance and then they give us the ability to trade. That money that we put on is collateral to fund potential losses. So if we put $1,000 on, we can actually trade with up to $10,000 in the market. So we can take a position that's worth $10,000 in the market, even though we only have $1,000. And the reason is the system will simply liquidate us and trade out of our position if we're unable to pay further losses. So if we take a $10,000 position and we lose 10% on that position, we're losing $1,000. And so the $1,000 that we put onto the system gets sold out and is used to pay back the collateral and the loss that we made. So that's how we can trade with more money than we have, is that we're just simply putting money on to fund potential losses. And so Binance will let us trade with a lot more. Now on Binance, you're not allowed to go into debt. That is why you get liquidated if you're losing your money. And that is how the margin ratio works, which we'll go over in a second. But with collateral, we can also choose two different types. So we can choose USDT, which is we're using the stable coin USDT, which is a dollar equivalent, to fund our positions. So you can put $1,000 on the system through US dollar tether, stable coin, and then you have $1,000. You also have coin margined, which is where you actually use a crypto asset as the collateral to fund your positions. Which one should you use? Well, coin margined is a little bit more risky, because the collateral that you're using is a risk asset and it can go up and down versus the dollar. And so, your collateral is moving in value and your position is moving in value if you're trading it. So it can definitely be more risky. Most people will stick to USDT because it gives them a solid amount of dollars that they know that they're funding positions with. And it makes it easy to get in and out of trades and understand where your profit and loss is. We can also see this as well. You can screenshot or just pause for right now if you want to see this. But as we can see, USDT margined gives us great liquidity and it's easy to understand our profit and loss and potential risk. With coin, it may generate more profits in bull markets because, of course, if you're margining with Bitcoin and then you're going long Bitcoin, it's like leveraging up your Bitcoin by using your Bitcoin. You don't have to sell it to then, margin with dollars. So there are reasons why you should use both. Most people use dollars to margin their positions. Now we'll get on to the margin ratio on Binance futures. If you are trading futures, you can take leverage, like I said, trading with more than you have. Now, this margin ratio will become important. This is essentially a ratio between the collateral that you actually have to pay for losses and the amount of equity in your account. If you're trading with more than you actually have and you're in big profits, then this margin ratio is going to be in the green and you have no issues here because you have a lot of profits and you're not having to fund any losses. However, if you start to make losses, then this will start to go into the red because the ratio between the amount of collateral that you have and your losses is getting thinner. When it starts to get down very close, this will become into the red and they'll start shutting down your ability to take further risk and positions unless you get out of the trades or you put more equity into the account, as in you just fund it with more dollars. So this margin ratio is important to have a look at. I'll go through this quickly right here. If we go to the margin account right here, you should be able to see this. So this is a score and it's going to tell you how healthy it is. This is a score based on the amount of money that you have, cash, and the amount of equity that you have. And it comes out into these levels, as you can see here. So as you can see, if your margin level or margin ratio is above 2, right, then no problems. That means that, you have plenty of money to fund the trade and you can trade, borrow, transfer, and you're not going to get any margin calls or liquidations. As you can see, if you have 1.5 or under 1.5 collateral margin ratio, you actually can't transfer any assets out. If that goes below 1.5, you can see that you can't borrow anymore. And if you've got 1.1, 1.1 is 10%, right? So if you're looking at your equity above your collateral is 10% only, right? So you're very close to getting liquidated, right? Then of course you can trade, but then you can't borrow anymore and you get a margin call. This margin call is essentially well, it used to be a call, but now it's a message to say, do you realize you're about to get liquidated? And if the margin level is under, then you get liquidated, right? So that's it. So that goes in stages. And it's important to know that. So when you're looking at your trading, you do have to make sure that you're funding positions. And of course, if they go down, the system will trade out for you, liquidate you, and get you out of the positions. So that the most you can lose is all of your money, essentially. But the more leverage that you trade with, the easier it is to do that. There are different ways that we can use collateral to margin our positions on Binance. So if we're trading USDT margin perpetuals, as we're doing right here, which most people trade, we can use, of course, the stablecoin to margin our position. So down here, you can see single asset mode, and then up here, you can see isolated. So these two are linked. So we're going to click on single asset mode, and this essentially allows only USDT to margin the positions. So what we can do is send some assets into our futures trading account that is US dollar tether, that is used to margin the position. So that's the collateral that we're using. Multi-assets mode is where you can actually use some other forms of collateral as well into your US dollar tether margined futures account, and the dollar value of them is going to be used to fund positions as well. So you can actually, instead of trading out of them into dollars, you can use the dollar value of them to margin positions as well. Now, what's important here is that if you want to use this one, you have to go into cross margin mode. This is how you fund the different trades that you actually have. So if you want to use different types of assets to fund your trades, you have to use cross margin mode. If you're using a single asset, US dollar tether, you can use isolated margin mode. Up here, you can choose between them. Isolated margin is where the collateral that you have in your account is used to fund individual trades. So you have $1,000 in your account, you use $500 to fund a Bitcoin position, and you use $500 to fund an Ethereum position. Those are completely separate. So if the Bitcoin position loses money and you get liquidated, you're liquidated on that 500, but the other Ethereum position will not be touched at all. So that's isolated margin for each position. Cross margin is where you are using all of the assets in your account to fund all of your positions. So if one position loses, you can actually take equity out of the trades, and the collateral that you're using to fund other positions can actually get drawn down on as well. So this is slightly more risky in that you can potentially lose on one trade and it wipes out the entire account. So cross margin, I would say, is more risky, but it opens up the ability to trade with different types of collateral and fund different types of positions across your account. It may open up different types of trading as well. However, if you're just looking to take positions on price, most people will use isolated margin to reduce risk, and then they can go ahead and use single asset, so putting a stable coin in there and knowing that that's the value. So that's the difference between them, and you can choose the one that best suits you. There are two ways we can open positions on Binance. One is called one-way mode and one is called hedge mode. This just deals with the fact that we may have two conflicting positions in the same asset at the same time, because you can go long, you can go short. So what happens if you want to do that at exactly the same time? Well, we can go to settings and then position mode. One-way versus hedge. One-way mode only lets you open a position in an asset one direction. So if you're $1,000 long in Bitcoin, and now you actually want to go short $500 of Bitcoin, you can't open a new position, but you can just close your long by $500. That gets you net in the same position, which is $500 long. Now with hedge mode, you can open two completely separate trades. You can open a long position for 1,000 and you can open a short position for 1,000. And so they're two trades and they can actually run at exactly the same time, and the P&L of those cancels each other out. So one way, you can only open a position, you can close it and then go the other way. With hedge, you can have two positions that are exactly opposite, one long and one short. Now let's talk about funding rates, because this is a big topic with trading crypto futures. Because futures are not the underlying asset, they're just a contract of the price of the underlying. Actually, the contract here, because of supply and demand on this market, may actually force the price of the crypto asset like Bitcoin away from the actual underlying spot price. And that creates an issue in that the futures contract isn't reliable as an avenue to trade the price of Bitcoin. So what futures platforms do is that they introduce this thing known as funding. Now, funding is like an incentive mechanism to traders. so that if the price of the crypto contract gets away from the underlying spot price, the funding rate will change to incentivize traders to do something to bring the price back into line with the spot contract. So, for example, if there are too many buyers in the futures market pushing the price up higher than the spot price, what will happen is that those longs who are buying have to pay a funding rate to short sellers because the longs are being penalized for pushing the price away from the spot price. That funding rate is paid from longs to short sellers. Those short sellers are being incentivized to sell short to keep the price down to bring it in line with the spot price. So we just have to know that funding exists and that we can either have to pay it or we may receive it as well, depending on whether we're long or short at the time. Now, this funding rate changes constantly to reflect how the market is positioned. Now, when there are a lot of buyers in the market and the price is going up, funding rates will probably be quite high for longs. And so you have to pay this. And so you have to manage that into your position size and the calculations that you're making, because this could be something that reduces the profits of your portfolio, especially if you're holding positions for a long time, then you're going to have to pay this. So we can work this out. On Binance, funding is paid every 8 hours. So you can just times this by 3 to get a daily rate. And then if you want to times that by 365 to get a rough figure on the kind of APY or APR on a yearly amount that you're paying for that position, you can do that. So 0.01%, so 0.01%, and then we can times that by 3 and then just do a yearly figure. So it's around 11% right now. So if you were to keep the position open for a year, you'd pay 11% on top as this funding rate. Now, it's not as easy as that because over time, this funding rate can change. This funding rate is positive right now, which means longs are paying. But if the funding rate is negative, then your long position will receive that funding as well. So it's difficult to know how this is going to react, of course, but it's something we must be aware of, and just make sure that you've got enough cash there for any funding. But of course, you're paying every 8 hours. And so if your position is only open for a few days or a few weeks, it's not a very big deal. However, what we can do is go to data, go to futures data and real-time funding rate. Click that. Takes you over to this page, which gives you the real-time funding rate of every asset in the market that you may want to trade at the current time. See the funding rate here, and then you see the time to the next funding, where that funding is actually exchanged between long and shorts, and then the interest rate of that funding, right? So that's done on an every 8-hour basis. That's important. And also what's very cool about futures is that we can actually trade that funding rate by, opening positions. So I'll go through that towards the end of this video, but something that futures allows people to do is not just take extra risk, but actually reduce risk in their portfolio. So you can see this funding rate arbitrage that can happen here. So as an example, let's say that there are many longs in the market and the funding rate right now is around, let's say 20%. In fact, I've searched for Bitcoin and the funding rate over the last 3 days or so as an annualized figure is around 20% interest on that funding per year. Well, that's pretty good. So what we can actually do as a trader is just simply collect that funding. So as an example, you can use a strategy where if you have Bitcoin, you can put Bitcoin in your account. So you're long Bitcoin, you can take a short position in the Bitcoin. And of course, shorts are getting paid by longs right now because the funding is positive. And so without taking any more market risk, you can actually just receive a yield from longs of around 20% per year. Now, of course, like I said, this changes over time as well. I will talk more about that towards the end of this video. Funding is there in crypto futures, and so you have to be aware of it and just know that it's going to change the P&L of your portfolio a little bit. Now we can look at trading with leverage and some of the calculations that you might want to do when trading with leverage, or if you want to do this. So I can't recommend trading with leverage, and leverage is extremely risky, and so I would heavily recommend not to use leverage, especially if you're a beginner. But as you can see up here, 5x, that shows that we're trading with 5x leverage. So every dollar position that we put in, the position that we're opening in the market is 5 times bigger than that. So a $1,000 position would become a $5,000 position. There's 2 ways to trade with leverage. You either just increase your risk by trading with more money than you have, or you can simply use leverage to open the same amount as you have, but just put less money down into the trade. And so you put less money down into the trade, you can use those assets for other things, for example, staking or earning yield, right? And so you're just using leverage to your advantage potentially. So you can either take extra risk, and that's just more risk and more risk of loss, or you can use leverage to your advantage to actually put less on the exchange, or put assets into other strategies that are earning some yield on the side or anything like that. So of course you can use an amount of leverage, as you can see here, but the more leverage you use is absolutely crazy and can lead to extremely fast losses. So how is leverage affecting your positions? As you can see here, you can simply take $1,000 and you can use 3x leverage and turn that position into a $3,000 position. You're now trading with way more money than you have. And of course, that is just extra risk. Now, what you can also do is just simply trade with less money down and open the same position size that you could anyway, because that's the actual money that you have. This is not extra risk. You're just using leverage to your advantage. Now, how does leverage affect your positions and sizes? Well, as you can see here, if you have a $1,000 position, a 30% or a 10% move on that $1,000 is obviously 100 with no leverage, right? So if you're using no leverage, then a 10% move to the upside, you get $100. A 10% move to the downside, you lose $100. A 30% move obviously moves that $300. 50% move is $500. Fairly self-explanatory. However, once you start adding leverage into the mix, things get a bit crazy, right? So now we're trading with potentially $3,000, and that's just more money than we actually have. Now, with 3x leverage, we now have a $3,000 position, and so a 10% move moves into a $300 win or loss, just 10% on that position. If you can see here, this 30% move would mean a $900 win or loss on that $3,000 position. But if we're using leverage, then what we're really saying here is that a 30% move on 3x leverage basically wipes out our account if it's a loss, because we've got $1,000 to fund the position. And so a 30% move on $3,000 that we have is $900. So about a 30% move, more or less, can wipe out our entire stack when leveraging up and trading with more money than we actually have. That's why trading with leverage is risky. It increases your ability to make money and returns based on your original stack. And it also makes it much faster on the downside as well. So your original stack right here, with 3x leverage, basically you're looking at a 30% move on that original stack that can wipe you out. So leverage is important to know and understand, in that, on the downside, it really can move very quickly. But of course, people use leverage in many different ways, and we can use it intelligently as well. Binance also has an order calculator that we can use to work out our liquidations if they may occur, and change our leverage to just be more aware of what's happening. So this up in the top right, click this, and then you have P&L. So you can work out if you have an entry price and an exit price that you think may happen. You can work out what your P&L may be here based on the quantity and the margin that you're taking. But we're going to look at liquidation price. So this doesn't matter for calculating, but as you can see here, we'll use an amount of margin like 5x, and let's say we're in at a certain price, and this is the balance of our account. So we're going to be using $1,000 as a balance. Now the quantity here, we're using 5x leverage. So the most, or the biggest amount of position that we could have is 5,000. So if you put like 7,000 in here, you can see calculate, and it says you don't have enough balance, because you wouldn't have enough balance to fund a position that big, right? So let's just put in here a quantity of 1,000 with 5x leverage. You can open that position, but you can see your liquidation price is 0. Why? Because you have enough to fund that position in its entirety. So you won't get liquidated at all. More or less, right? Because you've got some other costs and funding and everything. Let's put a quantity of 2,500. Click calculate. So we only have $1,000. So we are using leverage to actually have a larger position than we would otherwise be able to have. And that's the liquidation price that we get, right? Around 24,000. If we then put 3,000, you can see the liquidation price actually moves higher because, of course, now it's a much bigger position and our balance to fund that is much smaller. Let's put it up to 5,000. And you can see that liquidation moves up further because the quantity, the balance of our trade in the market is much bigger. And so a percentage move of that wipes us out a lot quicker. So that shows you where your potential liquidation price would be based on the amount of leverage that you're taking. That's important because when you come to actually trade, you're looking always with futures on what's the potential liquidation price, right? So what's the potential volatility of the move? Where do I think that it may get to for normal volatility? And if my liquidation price is down here, I'm good. If my liquidation price is up here, I'm probably taking too much risk. Before opening positions, we can do some very simple technical analysis on the chart just to give us some key price levels or support and resistance. And these are going to help us out with our risk, because if we're using leverage, we need to know our position at risk. And if our liquidation price is within our position, that's not good. We need our liquidation price to be away from. So what we can do here, I'm just going to very simply do some support and resistance levels on the chart for where we're trading right now. So we will draw some horizontal rays. And you can see the price trading around 43,000 right now. A big move to the upside here. So we need to look back at some key price levels. I would say this is a key price level, and probably one more to the downside would be around about here, right? So there are two levels to the downside where the price may get to. Now I'm going to be taking a long position as an example here just to show you. But as you can see, those key price levels, we actually have hit these a few times with the current price, right? So you can see the candlesticks here. We've hit that price level. We had a candlestick here, and we actually hit that price level again. So it seems to be this price level is an area of support. And that's good because if I'm taking a long position, the only thing I need to know with futures is what's the area where I'm going to stop loss my trade. So if I'm getting in here and the price moves down to here, then I need to get out of the trade because the trade is moving against me. Everything with futures is what is the position at risk and what is the level at which my trade is invalidated and I have to get out at a loss. Once I know what price that is, I can very easily work out how much leverage I can take, how much risk I'm taking. So everything with leverage and the risk that you're taking is done from your stop loss level. Once you know that, everything else works itself out. So very simply, just those two right here, and we'll show a long position from these levels of risk. There are a couple of options we can use when entering orders. So on the order entry screen, down here we have TPSL and reduce only. So TPSL, if we click this on, is a way to enter take profit and stop loss orders when you're entering your position. So we now have a couple of support levels on the price. If we're going long, support is to the downside. And these are potential levels where we may want to take a stop loss order, which is an order that exits our position at a loss to prevent further losses. And so we now know these levels. So let's say I want to trade to this level as my stop loss. So this first level is somewhere where we may get to, but this is the second level where if we get around this level, this is potentially my trade really failing, and essentially my trade idea of going long has been invalidated, and so I want to get out at this level, right? So that's around, let's call it 38,000, as you can see here. So that would be my stop loss. So you could put that in. And then the take profit level, again, you could either leave this blank or you could enter an amount that you want to take profits at. Now, this actually enters the order simultaneously to entering your actual position. So you have your open position right here, which we'll get onto in a second, but then you are entering a stop loss order at exactly the same time. You don't have to enter these right here. You can enter them at a later date, but that's TPSL. Reduce only, if we click this on, only lets us reduce positions that we have, and it doesn't let us add to them. This is like maybe like an insurance or just a risk button, so you don't add to positions and take further risk. So if you know that your positions are about the amount that you want and you definitely don't want to be opening more, it just prevents you pushing buttons in the wrong way. So it only lets you reduce positions and not open further risk. Let's open a sample long position then. Now that we know our stop loss level down here, we know exactly how much risk that we can take and leverage if we want to take it. So assuming you know what these order types are right here, if you don't, I'll leave some videos below. The Crypto Investor course has 300 videos now as well on crypto trading, futures, other parts of crypto. You can ask me to explain things as well if you want. So I'll leave that link below if you want to get a bit more pro. But what we can do here is just explain leverage. $1,000 position is the position in the market. And with 5x leverage, we're only putting 20% down. So a $200 cost to us opens a $1,000 position. What I'm going to do is change the BTC as the unit, because then we can work out how much we can trade via a trade calculator, because we know our stop loss level. So I'll go to a trade calculator. I'll leave this link below as well. 43,000 is our open price because the market right now is 43,000. So that's our open. We know 38,000 from that stop loss level is our stop loss. If we have $1,000 balance and we want to risk 2% of that, then we calculate, we can trade 0.004 units of Bitcoin. So that puts $20 at risk if we get stopped out at our stop loss level. Traders may trade around 1 to 3% risk per trade of their balance. But if this is your risk money, and it's your risk money, then, it's up to the individual, but I can't kind of promote taking extra risk or anything like that. But from here, we know it's 0.004 BTC. If we go back to the calculator, we can have a look and do some calculations about potential liquidation prices and how much money we have to put down. So if we do, 5x leverage here, it was 43,000, 0.004 BTC. Let's say we have $50 on account, calculate. So that would be our liquidation price at 30K. We can actually put less money into the account and our liquidation price. So that's insufficient here. So we'll go $35. That's about right. So our liquidation price would be 34,000. Our stop loss price is 38,000. That's good. Our stop loss is within our liquidation. We don't want our liquidation to be above our stop loss because we're taking too much risk. How about if we go to 10x leverage, press calculate. That's absolutely fine. Let's put $20 in, calculate. Now the liquidation price is 38,152. This is slightly above our own stop loss. So we're taking too much leverage or too much risk here. So what you can do at that 38,000 is either put more money into the balance, and that puts your liquidation price below our stop loss. That's fine because we know that we're getting out at 38,000. And so we know we have enough money to fund the position, right? And if we put 20 in, this is too much, right? So we need more in the account. Otherwise, we're getting liquidated before our own stop loss. And so 10x leverage is too much risk. Reduce the leverage a little bit, and then you don't have enough balance because we're trading 20, right? So you need to put a bit more in. And as you can see here, that's fine again. So this can show you exactly where your liquidation is and how much leverage you can use. Remember, if we're stopping ourselves out at 38,000, then that's absolutely fine. We can use as much leverage as we want, as long as the liquidation is away from our own stop loss. We still know our max loss is that $20 that we put in. So that's how to use leverage. You can use more or less depending on how much you want to fund of the trade. You don't have to take extra risk with extra leverage. Of course, you can do that if you want, but as you can see, all that does is simply, potentially move up the liquidation price. And if that's above your own stop loss, you're just simply taking more risk of loss in that trade. We can open a position then because the amount of risk we are taking is known to us. So I'll show you as an example, just 2x leverage here. We'll open a position. And as you can see, I need to fund around half of that. 2x leverage is funding half by long. And that seems to have gone through. So now we have an open position down here. So the position is open, right? And you can see that TPSL we can add now. So I didn't add it when I opened, so let's add that. We know that the Stop loss here is 38,000. That's the price that we want to get out at. So we're losing that much. Now, of course, you can do the volume here. So 100% of the position. So you don't have to take 100% stop loss. You can do like 50% or whatever. But for a stop loss, you're probably just, that's like the last bastion. You need to get out, right? So 100% of the amount. And then you can confirm that. So we're just going to confirm this. And that stop loss is in. So you can see the detail now. So detail, that's your stop loss order. That is what's known as a trigger order. So when the price gets down there, the order will be triggered to sell at that price. You can, of course, up here, just cancel that, right? So you can do that. You can cancel all. We'll just leave that for now. There we have the symbol that we're trading, the position size, the entry price, the mark price of the contract. This mark price is the contract price that will determine liquidations, because prices in the market can fluctuate wildly and sometimes be wrong, right, through an error or something. And so the mark price is the contract price which liquidations get traded at. And it moves a little bit more slowly than the market price. So that's good for us. We can trade at the mark price. You can see the margin ratio here is 0.8, very low because we're using only 2x leverage. Margin here is isolated, and then you have the running P&L of your position. And then you can have the order box here to actually close or edit your positions. You can also put all of your open positions on the chart to make it easier to read them, because you may not know where your entry is or your stop loss is. This is up here. So come to this display settings, click open orders. That opens the orders that you have in. Now remember, we have a stop loss. So that is an open order, right? It's not traded yet. And so it is in the system for us. Then we have positions, and that shows us our open position and whether it's in a profit or loss. So that perfectly matches up with our TA right here. So we know that this is our position and this is our potential stop loss. We're in that long position. From here, we can also edit or shave our positions. And so like I said, this is going to be different between one-way mode and hedge mode, depending which one that you're in. But for right now, I've opened this position, and so I can close some of this long by going short. So what I can do here is show you this. So these are my open positions down here, and I can close any open positions that I have. So we have this open position of this much. So let's close a portion of it. So I'll show you this with, let's say, 25% of the portfolio, or let's just do 0.001 like that. And I'm going to use a limit order. I'm just going to have the limit order above just to show you. So the limit order price is this. So we're trying to sell at that price, which is above the current market price. If you press limit, click that, it actually opens the order for you. You can now see that that order has appeared. Remember, we are showing our open orders. And so we have an open order in the system to sell at this price now, to close some of our position. Of course, we're not traded because it's above the current price. So I'm going to click this down to cancel this order, and that cancels off. So I don't have to go into my open orders and mess around down here. I can just do it on the chart if I want. So what we can also do is, of course, close this position entirely. So what we can do is press the amount that we want to trade, which is the amount of the position, and then you can press market order to trade out of that position, and that gets you out. So if we want to take this position out, market, and that entirely closes the position, and now we're out. And as you can see, we now have that stop loss taken out as well. Because that stop loss is associated with our order, we are now out of that position. And so we can't have that order there anymore. And so it cancels out as well. So you don't have to worry about canceling out that separately. If you sell short, then everything is reversed. When you have a short position, you are essentially selling and then looking to buy back lower. With short positions, you have unlimited risk because the price can move to infinity. Although in general, you would be placing a stop loss, at some point above to take losses there. Because if you're selling first, then you're losing money when the price goes up. So we can do that as well. So if we take another position here of exactly the same amount, and we can put a TPSL. Now the stop loss here would be above our entry. So let's put 47,000. And then we can sell short, and we enter that position, and that position is now live. We have that position, as you can see, and down here, we are making money when the price actually falls lower. So it's exactly the same here with positions. You have that, you can see that here, and then you can close that as well. So if we close a position via market, we can do that, and that will close all the positions for us. So if you take a short position, you are losing money when the price rises and then making money when the price goes down, because you will buy long at a lower price to actually close out that trade. Futures doesn't just let us speculate on prices. It also gives more professional traders the ability to hedge positions or just take arbitrage out of the market. Like I said with the funding rate earlier in the video, there is this page on Binance. You can get that via the data page up at the top. So if you go to data, futures data, and then arbitrage data, that takes you down to the funding page. Now with US dollar margin or coin margin, you can see that here. It doesn't really matter either or. We'll do arbitrage data right here, and we'll look at, for Bitcoin, the arbitrage data. What we can see right here is that there is a 26% positive funding rate as an APR over a year in Bitcoin right now. And what that means is that if you are short Bitcoin in the futures market, you're receiving that funding rate from longs. So what a lot of people may do is take what's known as a delta neutral position. Delta neutral simply means you're not taking any risk on the price of the asset that you're trading. So you're trading an arbitrage strategy. So you're long one Bitcoin in spot, you're short one Bitcoin in futures, your net position is no Bitcoin at this point. Why do people want to do that? Because they're skimming the funding rate. So they're taking no market risk, but they are getting this yield out of the market. Now there are risks here, of course, because if you've now got a net position of no Bitcoin and Bitcoin goes up 50% that month, then you would have rather just held the BTC. So there's risk with everything, but what delta neutral specifically relates to is the specific risk of that trade, because you don't have any market risk for this arbitrage position, but you are taking risk because the risk is opportunity cost. So that's how traders trade arbitrage, is that what they would do is take the coin and then put it in here to fund a short position. So you're long at the same amount that you're short. And if the funding is positive, you're receiving that funding. It is not without risk because it has opportunity cost to be out of the market, but you are taking the yield, whatever that may be at the time. And of course, with futures, you can either use Bitcoin through coin margin, or you can use BTC to fund a USDT position as well, because Binance allows you to do that. That is how arbitrage works. I'm not saying if it's good or bad, there are risks to everything, but that's how using futures can actually give traders, more avenues to trade rather than just taking speculations on the price one way or another. I'll leave a link to the Binance bonuses down at the top of the description. The Crypto Investor course as well has 300 more videos, and you can ask me questions if you're confused about anything. More helpful videos down at the bottom of the description as well. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.